The Intelligent Investor by Benjamin Graham is a classic book on value investing that has had a profound influence on generations of investors and finance professionals. First published in 1949, the book provides timeless lessons on how to approach investing with a disciplined and rational mindset. Graham's principles have guided some of the most successful investors, including Warren Buffett. In this extensive exploration, we will delve into the key lessons and concepts presented in the book. Lesson 1: The difference between investing and speculating. Graham makes a clear distinction between investing and speculating, emphasizing that investors seek to preserve and grow their capital over the long term, while speculators often gamble on short-term price movements. Investors focus on the fundamentals of a company, such as its financial health, competitive position, and long-term prospects. They aim to purchase stocks at a reasonable price and hold them for the long haul. Speculators, on the other hand, are primarily concerned with predicting short-term price movements. They often rely on market sentiment, tips, and hot trends. Lesson 2: The margin of safety. Graham's concept of the margin of safety is central to his approach. It involves buying investments at a price significantly below their intrinsic value to protect against downside risk. Margin of safety: investors should only buy securities when their market price is considerably lower than their intrinsic value. This provides a cushion against potential losses. Intrinsic value: determining the intrinsic value of a security involves analyzing its financials, future cash flows, and the sustainability of its competitive advantage. Lesson 3: Mr. Market's mood swings. Graham introduces the allegory of Mr. Market, a manic-depressive character who offers to buy or sell stocks to investors every day at varying prices. Investors should not be swayed by Mr. Market's emotional fluctuations. Market volatility: Graham advises investors to take advantage of Mr. Market's emotional swings by buying when prices are low and selling when they are high. Emotion versus analysis: successful investors base their decisions on careful analysis and fundamental value rather than market sentiment or short-term trends. Lesson 4: The defensive investor versus the enterprising investor. Graham classifies investors into two categories: defensive and enterprising. Each group has different objectives and risk tolerance. Defensive investors: these individuals are risk-averse and prioritize the preservation of capital. They focus on low-cost, diversified investments, such as index funds or bonds. Enterprising investors are willing to put in more effort and take on more risk to potentially achieve higher returns. They engage in individual stock analysis and actively manage their portfolios. Lesson 5: The importance of diversification. Graham advocates for diversification as a risk management strategy. Diversifying across various asset classes and industries can help reduce risk. Diversification, spreading investments across different assets, such as stocks, bonds, and real estate, can mitigate the impact of poor-performing investments. Avoiding overconcentration: Graham warns against overconcentration in a single stock or sector, as it can lead to substantial losses. Lesson 6: The long-term approach. Graham encourages investors to adopt a long-term perspective and to avoid frequent trading. Long-term investing with a focus on the long term allows investors to ride out market volatility and benefit from the power of compounding. Minimizing trading costs: frequent trading can lead to high transaction costs and taxes, which can erode returns over time. Lesson 7: The risks of over-optimism and over-pessimism. Graham cautions against letting over-optimism or over-pessimism drive investment decisions. He emphasizes the importance of objective analysis. Market psychology: investors should be aware of the psychological biases that can lead to irrational decision-making, such as herd behavior and the fear of missing out, FOMO. Contrarian thinking: contrarian investors go against the prevailing market sentiment, buying when others are pessimistic and selling when others are euphoric. Lesson 8: The role of research and analysis. Graham emphasizes the importance of thorough research and analysis when evaluating investments. Informed decisions: investors should base their decisions on comprehensive analysis of a company's financials, competitive position, and industry dynamics. Avoiding hot tips: relying on tips, rumors, or speculative information can be risky and lead to poor investment choices. Lesson 9. The impact of inflation. Graham acknowledges the corrosive effect of inflation on the real value of investments. Inflation protection. Investors should consider assets that provide protection against the eroding effects of inflation, such as stocks and real assets. Fixed income risks. Fixed income investments, like bonds, can be negatively impacted by inflation, as their future cash flows may be worth less in real terms. Lesson 10. The evaluation of stocks. Graham outlines a systematic approach for evaluating stocks based on their financials. Price to earnings (PE) ratio. Investors should consider the PE ratio as one of the key indicators of a stock's valuation. Earnings stability. Companies with a history of stable earnings are often more attractive investments. Dividend payments. Dividend payments can provide income and are a sign of financial strength. Financial strength. Investors should assess a company's balance sheet, debt levels, and liquidity. Lesson 11. The defensive investor's stock selection. Graham provides specific criteria for the defensive investor to select individual stocks. Large, well-established companies. Defensive investors should focus on established companies with a long track record of stability. Diversification. Investing in a diversified portfolio of stocks is prudent for defensive investors. Avoid speculative stocks. Stocks with high price-to-earnings ratios or unproven track records should be avoided. Avoid timing the market. Defensive investors should avoid trying to time the market and instead adopt a buy-and-hold approach. Lesson 12. The enterprising investor's stock selection. For enterprising investors, Graham outlines a more active approach to stock selection. Market opportunities. Enterprising investors can seek out undervalued or overlooked stocks with growth potential. Bargain stocks. Stocks trading at significant discounts to their intrinsic value are attractive to enterprising investors. Contrarian approach. Enterprising investors may take a contrarian approach, buying when others are selling due to market pessimism. Lesson 13. The role of bonds in a portfolio. Graham discusses the inclusion of bonds in an investment portfolio. Fixed income investments. Bonds provide stability and income in a portfolio but may have lower potential returns compared to stocks. Balancing risk. Bonds can help balance the risk profile of a portfolio, especially for risk-averse investors. Lesson 14. The investor and market fluctuations. Graham offers insights on how investors should respond to market fluctuations and crises. Market fluctuations are inevitable. Investors should expect and be prepared for market fluctuations, which are a natural part of investing. Maintaining composure. Emotional reactions to market volatility can lead to poor decision-making. Staying calm and rational is essential. Opportunities in crises. Market downturns can present opportunities to buy undervalued assets. Lesson 15. A final word on the margin of safety. Graham emphasizes the importance of the margin of safety as a guiding principle for investors. Conservative approach. Investors should always err on the side of caution, seeking investments with a substantial margin of safety. Risk management. The margin of safety serves as a safety net to protect against unforeseen risks and adverse events. Lesson 16. The investor's character. Graham discusses the role of an investor's character and temperament in achieving success. Discipline and patience. Successful investors exhibit discipline and patience, sticking to their investment strategies even during challenging times. Avoiding impulsiveness. Impulsive decision-making can lead to costly mistakes in investing. A rational and deliberate approach is key. Lesson 17. The influence of great investors. Graham acknowledges the influence of great investors like Warren Buffett and their adherence to value investing principles. Learning from great investors, Graham encourages investors to study the strategies and philosophies of successful value investors. Long-term perspective. Successful investors tend to have a long-term perspective and focus on intrinsic value rather than short-term market movements. Lesson 18. The evolution of investing. Graham touches on the evolution of the investment landscape, including the rise of index funds and passive investing. Passive versus active investing. Graham acknowledges that passive investing, such as investing in low-cost index funds, can be a viable strategy for many investors. Adapting to change. Investors should adapt to changes in the investment landscape while adhering to sound investment principles. Lesson 19. The Investor's Creed. Graham concludes the book with the Investor's Creed, summarizing the key principles of intelligent investing. Patience. Investors should have the patience to wait for attractive opportunities. Discipline. Disciplined adherence to a well-thought-out strategy is essential. Conservatism. A conservative approach that emphasizes the margin of safety is prudent. Skepticism. Investors should maintain a healthy skepticism and conduct thorough research. Self-reliance. Relying on one's analysis and judgment is crucial. Humility. Acknowledging that mistakes can happen is a sign of humility. In conclusion, The Intelligent Investor by Benjamin Graham offers a comprehensive guide to value investing, emphasizing principles such as the margin of safety, rational analysis, and a long-term perspective. Graham's lessons are designed to help investors navigate the complex and often unpredictable world of finance with a disciplined and cautious approach. By following these principles, investors can increase their chances of achieving financial success while minimizing risks and avoiding common pitfalls in the investment arena.